Hello guys, welcome to Understanding Fundamental Analysis in Forex Trading. And this course is going to cover all aspects of analyzing financial data, economic trends, political data and political trends to be able to use that information to predict the direction of the markets over a long-term period of time. So, first of all, fundamental analysis is the method that investigates economic, political, and social factors to assess an asset's true value. Now, in Forex, fundamental analysis helps traders to understand the forces driving currency's value beyond price charts. So, this is just a step ahead of price charts. You can be able to use economic data, fundamental data to understand the forces that are driving price action over a long-term period of time. Now, by examining data like growth rates, employment, and inflation, traders can evaluate a currency's fair price and make more informed long-term trading decisions. Now, the key focus area in this our fundamental analysis course is going to be about economic health, policy decisions, and global context of what's happening in the global market, because majority of what we're going to be concentrating on is going to be related to forex trading, which is foreign exchange trading, currency trading. Now, you could also use fundamental analysis to analyze stock markets using some other stock trading fundamental data or the company's data, like the company's earnings ratio, the company's earnings data, and some of the company's government management and other news that you would hear from the company. Now, first of all, when we say the power of news, we're talking about fundamental analysis. When they say power of information, we're talking about fundamental analysis, because news alone or good news can affect a market in a particular way relatively to the way bad news can affect the market in a particular way. Now, regardless of what your technical analysis might be saying, fundamental analysis is just based on the sentiment of a larger spectrum of people. Like, for example, you hear a global news that war just broke out in a country like Australia. Automatically, you're going to know that the price of iron ore, which is one of Australia's highest exports to the world, the price of iron ore is going to go to the roof, because the supply of iron ore is going to be reduced, which invariably is going to affect the demand, in the sense that there will be more demand on iron ore, which at the end of the day is going to increase price. So, understanding simple things like interest rates, GDP growth trend, employment levels, inflation rates, central bank interest rates, government stimulus program, trade balance, geopolitical risks, geopolitical tension, all those simple informations can be able to give you an insight into what could play out in the market in a longer term period of time. And we're going to be focusing on all these things to be able to teach you how to use this type of information to predict the long-term direction of the market. Now, if you think of FA, that is fundamental analysis, as judging a book by its context, which is the underlying economic data, while technical analysis judges by the cover or price action. Now, you can see why fundamental is actually very, very important, because you are judging the economy by the exact data that are moving the market. And I'm going to explain some of the ways in which I use fundamental analysis, and I'm going to teach you the exact way I go about analyzing economic trend and social economic trend with fundamental data like GDP, employment level, inflation, central bank interest rate, and other fundamental data. Now, the three time zones of fundamental analysis. Now, fundamental analysis can be analyzed in three different time zones: short term, medium term, and long term. And in those different terms, there are different things that we look out for as a trader to be able to predict what direction is the market going to go over so period of time. Now, when it comes to short term, in short term we focus on central bank meetings, job reports like US non-farm payroll, that is NFP. For example, an unexpected Federal Reserve hike in federal rates or Fed funds rate can cause rapid USD spike, in the sense that as there is a rise in the interest for keeping your money with the central bank, or for commercial banks to keep their money with the central bank, there's going to be an increase in the dollar. And in the spillover effect, an increase in Fed fund rates also increases bond value for holding money in dollar, like, because the central bank issues bonds and those bonds are being issued at a particular interest rate. Now, this same interest rate that we're talking about here, which is the Fed rates or Fed fund rate, also has a direct correlation with the interest that are being paid on those bonds that the Federal Reserve also gives out to individual investors or institutional investors. Now, you can use the Fed fund rate data to understand what would happen with the dollar over a certain period of time, being that the interest on bonds, the interest of saving money in dollars, has gone up, which automatically would make the dollar price or the dollar value go up. Now, on medium term, which is 1 year to 5 years, we include economic cycles, election outcome, and commodity super cycles. Like, for example, there are commodities that are more needed at a particular point in time of the year. Like, for example, rare earth minerals currently is of very high demand because of the advancement of technology, AI, and battery. And the rare earth minerals that are used to make batteries and those chips, they are also going to be of high demand, because currently the demand for AI and the demand for battery going into green energy and transitioning into green energy has also caused the demand for those rare earth minerals to go up. Now, this is why we have commodity super cycle that happens. So if you understand a commodity super cycle, for example gold cycles, for example iron ore, copper, and other rare earth minerals, you can be able to predict the long-term direction in terms of, or let me say the medium-term direction, 1 to 5 years of that particular mineral or that particular resources. And also you can also use economic cycles, election outcomes to predict the long-term movement of currencies and all that. Now, a large infrastructural plan might raise demand for Australian dollar via iron ore exports. Now you can see the correlation I just explained here, that something might happen within Australia and it would adversely affect the price of iron ore, just because Australia is the major distributor of iron ore to the world. Now, we also have long term, which is 5 to 10 years, and at this stage we are considering demographics, tech adoption, climate policies. Like, for example, Japan aging population exerts long-lasting pressure on the yen's value. If the population reduces, there's going to be less people for employment, and automatically is going to affect industrial production. So you can understand that if you understand some specific ways that things in the world, news, economy, trend, economic cycles, political cycles, and other things works, you can be able to use that information to predict a longer term movement of the market. And with that, let's say you have a long-term perspective of the market, you can now go in the market using your short-term entry bias with your technical analysis, and which is what makes fundamental analysis, or understanding fundamental analysis in itself, very, very important as a forex trader or as a trader in general. Now, the primary factors driving currency value are interest rate and inflation. And why do we say interest rate and inflation? Because number one, we're dealing with currencies. Currencies, the major force pulling a currency or driving a currency is the central bank. And one of the tools that central bank uses to drive a currency value is interest rate, by raising the interest that is being paid on bonds and also the interest that people pay on loan that they've taken from the central bank. They use it as a form of mopping out money from the economy. They call it mop-up system. So they use it as a form of mopping out money from the economy. So they can use interest rate to either increase the flow of currency in the economy or decrease the flow of currency in the economy just by raising or reducing interest rate. Another thing is inflation. Now, low inflation signals stability, but high inflation raises devaluation risk. Like for example, Zimbabwe's hyperinflation sharply contrasts with Swiss franc stability. Now, when we talk about inflation in terms of currency value, we know that the central bank, for example, the most important data they look at when predicting what they think is a fair rate for the interest rate is job data, which is employment data, and inflation data. Now, for example, somewhere like in the US, we have a 2% inflation rate to be a standard inflation rate, because at the end of the day, inflation can be good to an economy. At the same time, inflation can be bad to an economy when it is becoming excessive. So for them to balance interest rates, inflation has to be on a very good level. And for Federal Reserve, which is the US Central Bank, Federal Reserve, inflation target is 2%. So within 2% or anything below 2%, the Federal Reserve might not consider increasing rates. They might not consider mopping out money from the economy. But as soon as inflation starts rising above 2%, then you can see the central bank begin to increase interest rates. And you can understand that because of inflation now, you see how inflation causes central bank to raise or drop rates, also invariably causes the currency, which is USD, to either go up or come down. And that is why understanding this data, this fundamental data, understanding how it works in general, is going to help you as a trader very, very much. Now, additional major factors impacting Forex, which is Forex trading, foreign exchange trading, is economic growth, which is GDP, political stability, trade and currency account balance. And what do we mean by economic growth or GDP? A robust growth attracts currency appreciation by increasing asset demand. Now, GDP is a measure of calculating the strength of the economy, of every individual economy. And in the course of this video or in the course of this learning, you're going to learn more about GDP and how GDP can influence market price. Just the same way you're going to learn about how NFP, how inflation and other economic data would affect asset price or a currency value. Now, political stability also. Uncertainty from elections or scandals causes volatility. Like for example, for the GBPs, GBP did an 8% drop after BRICS voting, when the pounds or Britain were breaking out from Europe and they did this BRICS voting. Because of that, after voting and Britain dropped out of European Union, GBP fell by 8%. So if you already had such information, you already have knowledge about such things like this, you can be able to predict that, okay, if this situation happens, this is what's going to happen, and if this situation happens, this is what's going to happen. Then also we have trade and currency account balance, where we have that trade surpluses raises currency demand, as seen in Chinese yuan. When, for example, you can see in the Chinese economy, where as the Chinese economy started increasing output of products to the world, it significantly over time increased the value of yuan. So basic understanding of things like this can help you predict the long-term movement of yen over a long-term period of time. Now, why fundamental matters to forex traders? Number one, institutional moves. Hedge funds and banks rely on fundamental analysis, so ignoring it risks delayed reaction. So if you understand the fundamentals, basically you'll be able to know where the institutional traders are going to come in, when they are going to come in, and how they are moving. So just by understanding fundamental analysis alone, you understand where institutional orders might be coming in. Secondly, news also increases volatility in the market, or fuels volatility in the market. Now, economic reports causes 70% of forex volatility. News reports like NFP, GDP reports, interest rates, CPI, inflation data, because we understand that CPI is record for inflation data, also causes or fuels volatility in the market. An example is US swings during Fed speech. Whenever we hear there's an FOMC meeting, Federal Open Market Commission meeting, we know that most likely there's going to be increased volatility in the market. So preparing for times like that, knowing what the probability of like being able to predict what is going to happen or what the Federal Reserve might say at that point in time might prepare you for the directional path in a long-term perspective. Now, long-term edge, once again, fundamental analysis helps filter out market noises to identify sustainable currency trends, long-term trends. Now, this is just an introduction to fundamental analysis. After taking this course, you're going to learn in details how we use all this information, all this data to predict the price and the value of individual currencies, stock, and we're also going to learn intermarket analysis, sentimental analysis. We're going to learn how to analyze political statements, how to analyze all this data, and at the end of this course, you're going to be able to use those data to make predictions by yourself, being able to use them to understand long-term perspective of the market. So once again, it's nice to have you here. We'll meet on the inside. Bye.